Hi there and welcome to another episode of SidekickTV. I'm your host Rick Thorpe. In today's episode we're joined by Shayna King of Loan Market South, and we cover off how long do you need to be self-employed for before you can borrow from the banks, what the banks like to lend on in terms of security, and what the best approach to getting lending is. We'll also have all of the links that you require for the resources that we talk about in the video. And if you like it, please do like and subscribe. Cheers. G'day and welcome to another episode of Sidekick TV. Today I'm joined by Shayna King from Loan Market South, and we're talking about how self-employed and small business owners can basically work with the banks and obtain finance for any of the purchases that they may need to do. So Shayna, great to have you with us.
Yeah, thanks for having me.
Awesome. Shayna, let's as we've been discussing and preparing for this video, we'd come across I suppose that the concept that there's a lot of new to business people at the minute, and they just think, unless I've been turning over in my business for 2 years, I just can't borrow. Could you run us through that as a first starting point?
Yeah, of course. So we specialise in residential lending, so whether that be purchasing an owner-occupied property, investment property. So there are key differences between how the banks will assess self-employed income. Nowadays, to get your lending approved we've got responsible lending code, we've got CCCFA legislation. It's all about evidencing your income after you've nailed your deposit, of course. And for self-employed people, it's notoriously harder to get lending approved. So that's one of the key reasons why people will talk to a mortgage advisor and have a mortgage advisor on their team. Say, for example, you've been in business, 3 years, so the traditional standard will be, we'll look at your last 2 years of trading, we'll look at your last 2 years financials from your accountant, and we'll be able to, workshop that income in order to present to the bank as much income as we can according to how that bank assesses. So obviously each bank does have differences in their policies and how they'll look at income. Having said that, if you haven't been in business for 2 years, there are a number of options. It just depends on, it is a case by case, so it does depend on the nature of the business, your history with the industry. Say, for example, you're an accountant and you've been an employee for 10 years and now you've purchased a book and gone out on your own. That scenario is much easier to evidence an ongoing income. To the bank, we can do things like projections to show, income from that book over the next year or 2 years. That scenario is quite simple to, I would say, more simple to get across to a lender to evidence that income to be used in the assessment, compared to someone that, for example, has been an accountant and is going out to become a builder with no trading history and things like that. So it is case by case. 2 years is the golden rule. So if you've been trading for 2 years, great. We'll look at your financials. We'll look at, obviously your profits, your turnovers over the last 2 years, and also we'll take into account things like your plans and your growth plans for the future. Having said that, there are options if you're trading for less than 2 years.
Yeah, great. Because, we do see it and have seen it a lot over the last few years where businesses have preferred to have people contracting rather than being employed, in the relatively uncertain environment. But most of those guys have carried on really well. So they've they've been an electrician or they've been a builder for X amount of years, gone out on their own, predominantly working back with the same people, but then they just think that they're unbankable. So you're saying in that scenario, they've got that continuity. Yeah.
In that scenario, if we can evidence ongoing contracts, that really helps build the story to the bank. It's all about giving the bank comfort around your future income. That's really what it comes down to. So anything you can give us, including obviously your financials from your accountant, but then your contracts moving forward, even if it's multiple contracts, that really helps build that picture. Even if you've got just a year's worth of contracting, but you've got all this future contracts you can evidence, that really helps kind of pad out the income that we can use. So
yeah,
that scenario is probably pretty common.
Yeah, great. And then the other thing I've come across as well is, again, coming back down to timing, is if you then needed to go buy your tools or your ute or whatever for that new job, perhaps do it while you are still employed.
Yeah. So if you've got residential security, you've got equity available in your property, it's quite common for us to be able to use that equity to purchase business assets. For example, we've got someone wanting to buy a new home, or looking at selling and buying a new home, and then they're going to have substantial equity in there, and I can see on the side that they've got $40,000 car loan for their business, that they might be paying 20% or 18% interest rate over a 5-year term. We can do a number of things, such as consolidate that business debt against the property in order to lower the interest rate essentially, and increase how much you can borrow for your new home. Same goes if you've got equity in your property and you were looking at purchasing an asset for a business, like you say. It's just a matter of us getting, evidencing the purpose of the funds to the bank and completing a loan assessment, affordability assessment, and then we can use your equity to get you a better interest rate and probably more favourable loan terms as well. Once again, it's when we're dealing with self-employed clients, they have a lot of more specialist needs than I guess your standard employee with the wage or salary. So it's looking at your whole situation holistically, seeing what your goals are with the business, seeing where your debt and where your pain points are, and how we can actually workshop that with the residential lending that we can approve to kind of get you moving forward.
Yeah, excellent.
Yeah,
and it's there's so much more information together. Hey, so you've mentioned a couple of times, assets, houses or residential lending, the vehicles or what have you. My experience, and in talking to a number of bankers over the years, is the banks really love to lend on things. So a business isn't always classed as a thing. And they don't really like lending on thin air. So what would your recommendations be to clients where they might be purchasing a business or needing to borrow?
Yeah.
What would you recommend?
Yeah, so once again, if we've got a security such as a property with equity, I actually had a call this morning from a client in a similar position. It's about assessing their overall financial situation. Have they got equity in their property? If they do, great, we can potentially use that as security to release the funds to purchase that business. And then from there, it's about evidencing the income side of things and the affordability of that lending. So if you're purchasing a brand new business or an established business, there should be obviously financials coming with that. We can working with your accountant to get some forecasting done. If one of you is dropping income to move into the new business, how does that look for maybe your existing business? So it's just about workshopping, especially workshopping with your accountant, and of course getting legal advice as well. So I would consider your mortgage advisor as a key integral part of your financial wellbeing team, whether that's purchasing a property, structuring your lending, purchasing assets for the business, repaying debt. You've got your legal advice, your accountant advice is obviously key, and your mortgage advice and your loan structure is really important. So one very big example I would say when I'm talking to, say for example, you're self-employed tradie or painter, whatever it might be, and they are wanting to purchase a new home, whether they're a first home buyer or wanting to buy an investment property or buy sell and upgrade their home, they might say, I'm with Bank A, and I've always been with Bank A, I'm happy with them, I'm happy with the service I've had, but they don't necessarily understand how Bank A will assess their financials. So that's another really important thing of reason to talk to a mortgage advisor. When we're looking at your financials, we know the ins and outs of how each bank will assess those financials, and some banks will look at them quite differently. Some banks will take your profit and add your depreciation back in as example, like if you've got vehicles in the business, you've got quite high depreciation, that's income that we can add on top to increase your affordability for lending. Some banks will add that back into the calculator, some banks won't. So Bank A versus Bank B might end up with quite different results in how much they will grant you as a loan.
And that's to the average punter looking for a mortgage, that's completely invisible, I'm guessing. There's no way you'd see that, you know, on the shop window kind of thing.
Yeah, exactly. You know, a lot of people would have had this experience of walking into a bank and thinking, I've been with this bank for 20 years, I'm a loyal customer of theirs, and then being told, no, you can't borrow anything, or you can't borrow what you need to borrow, what you want to borrow. That person sitting at the bank, of course, cannot tell you if you walk down the road to another coloured bank, they might approve you for a lot higher. So obviously that's just one of the major benefits of using a mortgage advisor, is that we're dealing with these lenders every single day. Another key element with, especially for self-employed clients, is that quite often the bank will have a specialist division for business banking, and the banks that do are used to dealing with self-employed clients on a daily basis. When it lands on their desk, they're used to looking at financials and how we're presenting the lending, whereas if you walk into a branch, you may not get the same experience with someone that's familiar with your industry or your financials.
And there's lots of other stuff that goes on with that as well. Hey, like you talk about, say, depreciation being one thing. There's a lot of kind of accounting wizardry that we try and do, which is quite useful when it comes to paying your taxes, but can be quite detrimental when you're trying to borrow money. And so, but it's about getting the right balance. You know, we work with clients all the time where might have a smallish old house that they've got a room set aside. They've then got a double garage over at the side. So actually, their claim at home for their business is quite significant. I was running the numbers with someone the other day, and a $500,000 mortgage, and you know that kind of scenario could end up that the home office contribution is legitimately $15,000 or more.
Wow.
That goes a long way to servicing some debt. How do we present that in the best light to the bank to go, well, it is income, it's not income?
Yes. Yeah, so each bank has rules of their, you know, what they will pick out of your financial statements to use as income in the affordability assessment. Luckily, use of home as office is very common, that we will be able to add that back in because it is genuine income. Depreciation, as I said, that's dependent on the lender. Interest cost, of course, is that's part of your income as well in terms of assessment. Your profits, of course. So there's a number of, I guess, ways that we'll workshop that lending depending on which lender we're able to use to get the maximum lending possible for the client. I would say the trickiest thing at the moment is, of course, you mentioned cost of borrowing and interest rates, is, of course, the test rates. So how it works is we've got, you know, your deposit, your income, and then your expenses, and your expenses include all your outgoings and your existing debt repayments. Any residential lending is actually tested on a higher test rate in terms of calculating your repayments and how much you can afford to borrow. They have to add, you know, quite a decent buffer in there to account for, you know, potential increases in interest rates, hopefully not anytime soon. So that means at the moment in the market, it's currently tested at around a repayment of 9% for most lenders. So that means that kind of, I would say, is probably the major hurdle at the moment for a lot of people is, of course, the interest rates. You know, if you've got an existing home, for example, you've got a owner-occupied house with, you know, $1 million or whatever it may be, and you've got a $400,000 mortgage, and you say, I want to borrow against that home. They've got good equity there. I want to borrow to buy an investment property of $600,000. Well, already that $400,000 and that $600,000 loan tested on a 9% interest rate is, you know, $90,000 per year just on the interest. And that's the calculation the bank has to use. Then you've got your principal repayments, rates, insurance, your living expenses. So it's quickly starting to add up. So that's why, evidencing that income and using all the parts of the income that we can from your financials is really important to get those numbers to offset, really.
Totally. And the thing is, the maths isn't always that easy either, is it? Like, I do this quite regularly. I'm such a geek. I've got in my bookmarks bar a mortgage calculator saved. Because when you put different terms on it, commercial buildings usually max 15 years, houses usually 30, investments maybe different or it differs with banks. So it is something that clients can do a lot of their own research on, isn't it? Well, just to check the numbers.
Yeah, I guess it's when I'm having an initial conversation with someone wanting to borrow more money, it's obviously important to, establish, I guess, expectations and try and gauge, what's your current income, things like that, before we actually delve into doing the full assessment. But as well as the expectations for borrowing, also the expectations for repayments. And at the moment, it is of course always based on interest rates. So rates at the moment, late high 6s to 7%. And of course, we're hoping that there will be some slow decreases in that over the next year. But yeah, that kind of is the main hurdle for a lot of people at the moment, is that those high repayments. You do kind of have to be on significant income to be borrowing those levels. Yeah.
And it's going to be sticky for a while longer, I understand. Like we do need to go and beat up the Reserve Bank with a stick a bit and get those rates down, that OCR. But we're expecting, aren't we, that it's going to be, by the end of this year, still 5s, possibly high 5s at best, are we?
Yeah, I would think that would be a great goal.
Yeah, right.
If we did get there. No one knows, no one has a crystal ball. As a financial advisor, I get asked this every single day. Yeah. What I will say is the genuine consensus is rates will start to slowly come down. It's all dependent on inflation figures, of course, which is dictated by
how much money they printed 3 years ago.
Ridiculous amount of factors. global politics, everything. At the moment, I would say most people would be fixing their lending for shorter. I wouldn't recommend anyone fixing it, too long a period, unless you really want to pay a little bit extra for that certainty. A lot of strategies at the moment is, splitting your loan and really looking at your loan structure to hedge those bets against inflation, interest rate changes over the next couple of years. So maybe you do some portion of your lending on a 6-month, some on a 12-month. Another really popular loan structure, especially for self-employed people, will be having like a revolving credit facility or flexible facility. If you've got income that fluctuates, for example, real estate agents or commission earners, that type of thing, having the ability to offset some of the interest paid and pay back lump sums, but still have access to get that money back in terms of a revolving loan, it can be really good, for business use and things like that.
Yeah, we're actually seeing clients do this again now. We used to have it all the time, nearly all of our clients, probably 8-9 years ago, when 6% was a good rate then. And so if you could save your GST and your terminal tax amounts and all of that, and just have that offsetting at home, it can be a significant amount, it can be, I think at those rates, for any $100,000 that you might have as cash at any given reason, which you're just looking after for the IRD, that can save you $2,000 to $3,000 a year if you're offsetting it. So worthwhile doing if that's the scenario that you're in.
Definitely, and review your loan structure when your loans come up for refix. Check in with your mortgage advisor, and make sure that loan structure is still working for you and your business. There's different bank products which are really specialised for that exact type of thing. Like Westpac has like offset products and Choices Everyday Loan, it's called, where you can kind of use your funds from your business, like you say with your GST, offset interest payable, and then review it again after that, after you've made the payment. And other banks have similar products, so it's well worth just checking in and making sure your loan structure, even if you're not purchasing a property, just review your structure with your refixes and make sure it's all
Perfect. And the key thing to this is get advice when you're doing it, okay? So anything we've said in this video is not personalised, tailored advice, okay? Chat to someone about your situation because, and again, you probably need to chat to a couple of people because, you know, it might be your accountants that have got an idea about what you can do, what you're allowed to do, what you should do, and when you need the money back for the tax payments.
Yeah.
But then speak to yourself. So then it's, well, what do I need from the bank? What facilities do I need? Because it is a bit complex, but it can save thousands.
Yeah, exactly. And that's another reason why, you know, self-employed clients, we have, with a lot of our clients, a close relationship to their accountants because we frequently, you know, clients will just say, talk to my accountant. So it's just much easier. And of course, we direct clients back to their accountant to get that initial advice on their structure as well. So
awesome.
It's really important.
Great. Well, look, there's been some absolute nuggets in here for people to that are self-employed and might be, you know, embarking on that kind of borrowing journey soon. So we will link to Shayna's details. I'll get from you if there's an even better loan calculator, and we'll pop that in the link as well. And if you've enjoyed this video and the others that we do, please do like and subscribe. Thank you very much.
Oh, thank you.
Cheers. Welcome to Sidekick TV. I'm your host, Ric Thorpe. Sidekick TV is the place for Kiwi business owners and entrepreneurs to learn all about finance, accounting, and how to run and operate a business in New Zealand. We're going to interview experts from the finance realm and fellow Kiwi business owners. Stay tuned.